Good afternoon, and thanks for joining us today for our webinar on personalized investing strategies, how to enhance returns and at the same time reducing risk. My name is Thomas Senek. I'm the founding partner of TM Wealth Management, and I'll be your guide today as we walk through this presentation and share with you some insights that I think will be valuable as we think about the upcoming upcoming year in the markets, and how to position yourself and utilize the tools and strategies to have the outcomes that you desire. Just a little bit of housekeeping as we share a little bit of our disclosures. Right, this is designed for educational purposes. This is not financial advice. It's not tax or legal advice. Please take any of this information to your professionals and work with them to find out how it applies to your unique situation. We'd be happy to sit down with you and answer any questions that you might have. At the end, we'll share with you how to do that. We're here to be a resource so that you can get the answers that you need to make the best financial decisions for you. Just a little bit about me. Started my career on Wall Street, worked for Goldman Sachs and Deutsche Bank in investment banking, did M&A and IPO transactions, and enjoyed that, but found that investment banking is not conducive to a family. And that was important to me. So years ago, transitioned from investment banking to wealth management and started TM Wealth Management over a decade ago to really help families and individuals make good financial decisions so they can have the positive impact on the people and causes they care about most. When I started TM Wealth Management, I knew specifically how I wanted to structure things because there were some key elements that were important to me. First, TM Wealth Management is independent, right? We don't have a home office or a asset management arm that's creating products to tell us, hey, we need to be, pushing this mutual fund or this ETF or these strategies. We are independent. Additionally, it was important to me that we stay boutique or relatively small because I don't know how you can add value to a number of client relationships if you are dealing with thousands of client relationships. For us, we like to keep it boutique so that we can spend the time to go deep with each individual client and provide strategies and solutions that are unique to them. Third, wealth management, right? You get a lot of financial advisors that all they focus on are your investments, stocks and bonds. And while that's an important element, we know that there's more going on in your financial life than just investments. That's why we want to be aware of any estate planning, tax planning, insurance needs, financial planning. All of these elements come together to help you make the best financial decisions for you. And then lastly, we are a fiduciary. It was important that we select a structure to operate under where we align our interests with the clients as much as possible. And so as a registered investment advisor, we function under the fiduciary standard, which puts a legal obligation on us to do what's in the best interest of our clients. So that's a little bit about TM Wealth Management. We're happy to be a resource for you. Please reach out to us, schedule some time with us so that we can help you make good financial decisions. Now, when I was growing up, I would go to church every Sunday, and I have two older brothers. And so I got hand-me-down clothes. And this is usually how I looked going to church, right? My suit was too big because it was my brothers. And my brothers are a number of years older than me, and a couple of them or one of them is larger than me. So I, had these oversized suits. So when I got out of college and could afford, my first suit, I decided that I would buy a suit that I felt fit off the rack and kind of look like this, right? Better. But then as I kind of got older and as costs came down for custom tailored suits, I went out and got something that looked a little more like this, right? And so as customization and personalization has improved throughout the economy, that hasn't translated directly to our investment selections or our portfolio construction. And as you think about the benefits of a tailored suit, right, it's better fit. It's designed to fit you. You can pick custom colors and fabrics so it represents who you are. And when you have this, it gives you greater confidence. It fits better and it lasts longer. Same thing when we think about custom or personalized portfolio construction. The more personalized it is, the more it reflects you, the more you're willing to stick with that investment strategy, the greater confidence you have that it's going to deliver the outcomes that you want, and you'll stick with it longer. And so that's what we want to talk about today is how do we structure a portfolio and your investments that are customized to you. Now, traditionally, investments were just stocks and bonds, right? 60-40 portfolio, 60% equity, 40% bonds. That's traditionally how portfolio construction has gone. And to me, that's kind of like building a house with the only tool that you have is a hammer. But if we open up the entire investment universe now to alternative or non-traditional assets, now we have commercial real estate, private equity, venture capital, commodities, hedge funds, all these different strategies now. And now in our toolbox, we have all the tools available to us so we can construct a portfolio that is personalized to you, but also has better outcomes. And as we add some of these non-traditional strategies, it not only increases the potential for returns, but it reduces the risk. And we'll talk just a little bit about that. So why do we want to add something other than traditional stocks and bonds? Well, this looks at the projections for long-term asset class returns by some of the largest investment houses on the street, right? BlackRock, JP Morgan, Morningstar, research affiliates, Schwab, and Vanguard, right? And if we look at this, US equities are projected somewhere in the 5 to 6% long-term returns on an annualized basis. And then if we look over here at bonds, right, even worse, right, 4 to 5% on long-term bonds. This is what these large investment houses are projecting we can expect equities and bonds or stocks and bonds to provide for us over the long run. Now, if we take a traditional 60-40 portfolio, that means that we have an expected return of 5.17%. Not a lot of financial plans and a lot of financial goals have the best outcomes if we're only to get 5.2% from our portfolio. So we need to start looking at other strategies and other assets to be able to provide returns and manage our risk profile at the same time. And that's where we also understand what is happening between stocks and bonds. And this graphic on the left that illustrates the US stock bond correlation, you can see this blue line. It indicates how much stocks and bonds move together, right? If they move up together, you see a large blue bar. If they move independent of one another, like you can see back here in the 2000s or 2020s, right? Very little correlation. They're not moving together. They're moving independent of one another. And so you can also see inflation, right? This gray line is inflation, right? So what we're seeing now is as stocks and bonds become more correlated, I mean, they're moving together, bonds are not providing that buffer that we want, right? It used to be, hey, if stocks are down, that's okay because our bonds are up or at least flat. Well, that's not happening. They're starting to move a lot more closely together. So bonds are not providing that buffer that we want in our portfolios. Additionally, on this right side, this graphic about number of private versus public companies, you can see here that the number of companies that you can invest in, public companies on the stock market, have been cut in half. If we use this right graphic, right, back in the 2000s, we had 7,000 to 8,000 public companies on the stock market. Now we're about 4,500. So almost half of the public companies are on the stock exchange. So less companies are going public and more are staying private. That's this blue line, right? So significantly higher and growth in public or private companies. So as we start to think about where we can invest, right? If there are fewer public companies, that means there's more dollars chasing fewer companies in the stock market. A simple supply and demand. So we need to start looking elsewhere in the private markets to be able to get us returns, but also to provide us a risk profile that meets our overall objectives. And that's where we start to look at this, what they call the efficient frontier. So if we take all the potential risks and the expected returns, which risk we in investing, we deal with volatility. So if all the expected volatility here is on this axis, and then the expected return, traditional investments, there's this efficient frontier or this graph that illustrates every single risk profile and what the expected return is. By adding alternatives, real estate, private equity, direct investing, all of direct indexing, all of these things now, not only do they increase the potential return, but it reduces the expected volatility or the risk, right? So if we look at where this graphic was initially, right, the same risk level, we can get a higher expected return, or conversely, we can get the same return with a reduced risk. So that's why we start looking at something other than traditional stocks and bonds, is because one, there are less and less public companies that we can invest in. Two, private or alternative assets have the potential to create non-correlated benefits, meaning things don't move together. So what we have now is the opportunity, by investing in alternatives or non-traditional assets, we can customize a portfolio that meets your needs, that illustrates who you are, but at the same time increase the potential return while reducing the risk. Sounds pretty good. Now, this is just another graphical representation of this efficient frontier, right? All of these lower pie graphs illustrate a traditional equity and bond mix, right? This lower graphic, 60% bonds, 40% equities. Here's our traditionals, 40% bonds, 60% equities, right? This is, and down here in this lower graphic where we look at these risk return perspectives, right? So here's our traditional 60-40 portfolio, has a projected annualized return of 8.7%. By adding 30% alternatives, so taking a portion of our equity exposure and adding that to alternatives, we shift our risk return profile. Now our risk goes down to 7.9% and our return goes up to 9.1%. So less risk, higher potential return. This is why we want to look at adding some of these non-traditional assets to our portfolios. So why do we want to personalize our portfolios, right? Because our portfolios, our investments should reflect your priorities, your values, and your risk return expectations. We also want to be more tax efficient, right? A lot of people that invest in mutual funds, at the end of the year, they get this big capital gains distribution. And you didn't sell anything, you held the mutual fund throughout the entire year, but because other people wanted to make redemptions or receive the income, the mutual fund now has to make these capital gains distributions. So it's not tax efficient for you. And lastly, we want to make sure that you have a professional managed account, that now you have somebody that's watching it on a regular basis to make sure it is consistently customized, tax efficient, and optimized to have the outcomes that you desire. So how do we do that? Right? Well, there's a couple of strategies that we utilize to meet these goals. One is First Trust direct indexing strategy, and we're going to highlight that and talk a little bit about that. We also utilize the private shares fund, which is a private equity strategy. So investing in companies like SpaceX and GrubMarket, companies that have yet to go public. And then private credit. So Benefit Street Partners, they provide a strategy where they are lending to private companies, and we're able to get a yield on those close to the double digits, 8-9%, while at the same time managing the risk that there's not significant defaults. And then lastly, at the bottom there, we have helped clients initiate a strategy of direct investment into data centers out west, right? So again, another direct investment into something that's both technology, but it's also real estate and also operations, right? So they're building these data centers, leasing them up, and operating them. So these are some of the strategies we use to personalize client portfolios. So let's talk about direct indexing, right? And essentially what direct indexing is, it's creating your own index. So if you think about the S&P 500, right? 500 companies. In there, you could structure your tracking of the S&P 500 with your positions, right? So individual securities that you would own, and you don't need to own the full 500 to be able to meet, to get the same risk return profile of the S&P 500. Excuse me. So we're going to talk about direct index, right? So in the end, what you do is you select a benchmark. Let's say we choose the S&P 500. You could also choose the Russell 2000 or whatever benchmark you want to follow. It could be a global benchmark as well. So we select a benchmark that we want to track, right? So for a lot of us in our portfolios that we structure, we want to track the Russell 2000 or the S&P 500. And we're going to have that exposure. We either do that exposure through an exchange traded fund like the SPY or VOO, or we can structure your own direct indexing benchmark. So once we select the benchmark, then we personalize it. You might say, hey, I don't want any oil stocks, fossil fuels in my portfolio, or I want to have it, really focused on companies that share my Christian principles, or however you want to personalize it. There are 70 levels of customization to your index. And then what we do is we structure the benchmark. Like I said before, if we're tracking the S&P 500, we don't need 500 individual stocks to be able to track the S&P 500. There's about 150 positions or stocks within the S&P 500 that drive the vast majority of the performance in the S&P 500. So as you can see in this pie graph here, if we did all 500, it'd be this larger graph. But if we just shrink it down to get a sample of the full index, get a similar risk return profile, we don't need the full 500 positions. And then the portfolio then starts to mimic the index with minimal tracking error. So it's not the exact index, right? The exact index would have 500 companies. We're using 140 to 150 that track it very closely, but there might be some minor differences. And so what we then do is we want to maximize the tax efficiency of your personalized direct index. And the way we do that is utilizing daily tax loss harvesting. So let's say in this example, your initial portfolio has HCA, BP, and Pepsi. And let's say Pepsi's down. You say, look, we want to realize that loss. Well, let's sell Pepsi and let's buy Coke, right? So we have the same type of exposure, right? Consumer goods, especially in drinks, right? So Pepsi and Coke are very similar in terms of the markets that they address. So we still have the same exposure in our portfolio, in our benchmark, but now we've realized the loss in Pepsi. So we stay out of Pepsi for 31 days. Then we can either go back and buy Pepsi or we can just stay with Coke. And we realize that loss. Those losses are used then to offset future gains. And as we're constantly doing daily tax loss harvestings, we're accumulating these losses that we can use to offset future gains, which makes the portfolio more tax efficient and also enhances our after-tax returns. So when we start to think about personalization, right, we want to choose a benchmark. We personalize it with the values that align with you, any account-specific needs, any ESG preferences. We structure that portfolio, and now it is yours. And then it's professionally managed to do this daily tax loss harvesting to make sure you're getting the same risk return profile, but being a little more tax efficient. And there's this power of compounding tax savings, right? So this is just looking at, a certain direct indexing that started in 2019. In the first year, you're going to have a lot more tax alpha, right? So 5% of the portfolio was realized in tax alpha, meaning tax efficiency. But as we move on, right, that tax efficiency goes down a little bit because now we're constantly managing the gains and the losses. So those losses become smaller and smaller as we manage the portfolio efficiently. Another way to think about this, right? So this is the S&P 500 returns from 2018 to 2022, right? And you can see, look, even in 2019, 2020, and 2021, the S&P 500 was up. But if we look at the actual 500 companies' returns on this graphic, right? So 2019, 2020, and 2021, just like in this graphic, all were positive returns. But in this year, the percent of stocks with loss harvesting opportunities, look at 2020, 95% of the stocks in the S&P 500 were down at some point and created a loss harvesting opportunity. So even though the markets ended up throughout the year and throughout the days, there are opportunities to realize losses that can accumulate to offset future gains. So you now in your direct indexing personalized benchmark hold these individual stocks now that you can utilize for tax loss harvesting. If you just held the S&P 500 exchange traded fund, you don't get any of these tax efficiencies. You're just holding those securities, whether up or down, you hold them until you sell the broad ETF. With your own individual index now, you can sell individual securities, realize those losses, and utilize those to offset future gains. So here's an illustration potentially, right? So if we look at the orange line, that's the S&P 500 performance from July 2022 to June 2023. And then we look at this dark blue line. This is your specific direct indexing S&P 500 account, right? So it's going to be a little different because we don't hold the full 500. But what this yellow line illustrates is what percentage of the portfolio has realized losses to offset future gains. And so you can see in 1 year, the portfolio, the S&P 500, was up just a little over 15%. And your account was up 20%. So it outperformed. That's an unusual, that can happen sometimes. Underperform a little bit, overperform, because again, it's not the exact index. But what I really want to highlight here is this yellow line. At the end of the year, you now have 15% of the portfolio that has been realized tax losses, but at the same time, you've realized the performance of the index. So let's say you put $1 million in this strategy a year ago in July of 2022. It is now worth 1.2 million because the portfolio has gone up. 15% of the portfolio now is losses. So you have $150,000 of losses. So that $200,000 of gain, you're only going to pay tax on $50 of gain if you sold this at the end of the year, because you can use that 150 of accumulated losses to offset those gains. That is a significant tax efficiency. And if you don't, sell your entire portfolio at the end of the year, those $150,000 of losses can be used to offset. Maybe you sell your rental home and you have a significant gain, $150,000 of gains. You can use your tax losses in your investment portfolio to offset any other capital losses or capital gains that you might have elsewhere. So pretty powerful tax efficient strategy, while at the same time personalizing your portfolio and also aligning that portfolio with your values, and really kind of like that custom suit, having something that really fits for you. Okay, so we covered a lot. We talked about, alternatives, specifically about direct indexing. Now, what do you do with all this information? Well, the first thing that I would suggest that you do is reach out to us for an initial consultation. There's no sales, there's no pressure. It really is to get to know you and see how we can apply this general information to your unique situation. So reach out to us, schedule that initial consultation. It's about a 15-20-minute phone call. We'll get to know what your needs are, answer your questions. And if there's an interest in both sides moving forward to a more formal conversation, we can do that. If not, that's okay. The other thing is we have a tremendous amount of resources. So you can reach out and ask us for any of these resources, whether it's understanding alternative investments, our estate planning or tax planning guides, anything that we can do to be helpful to you to help you make good financial decisions. And then lastly, some next steps, schedule that initial consultation. You can follow us on social media, or you can sign up for a weekly market update where we send out some of this information on a weekly basis to give you some insights about what we're watching and some strategies that we're looking at deploying as well. Hopefully that's been helpful for you. We appreciate your time. Hope you look to personalize your portfolio so you can get that increased potential return while at the same time reducing risk. Again, please reach out to us with any questions that you might have so that we can help structure a portfolio and investment strategy that is best for you.